Hey everyone, Anthony Venuto here with In Touch Mortgage Solutions. It's Friday, Finance Fridays, and thank you again for clicking on this episode. We're going to be talking a little bit about clients' options when it comes to locking into a fixed rate from a variable, especially if you're in that position to get that trigger rate notice in the mail. Stay tuned, you don't want to miss this episode. As September 7th fast approaches, many Canadians are apprehensive about the Bank of Canada's next policy rate decision, especially those on a variable rate mortgage, whether it be static or adjustable. For many Canadians on a static payment, they should be aware, obviously, that they may be approaching their trigger point on the next increase, as RBC is indicating around 80,000 mortgages may be breaching that trigger point, and that's just with RBC. Depending on your lender, you should be looking into what your trigger point is if you have already got a notice and what to do next. Now, obviously, for those Canadians who have an adjustable rate or floating mortgage payment, which means every time the Bank of Canada makes a move and the prime changes, obviously your payments change with that. And obviously for those Canadians, the pain has been felt for the last 5 months. Now, we had a client reach out to us that we'd originally done the mortgage for back in 2021. When we positioned this client with the refinance restructuring and giving them a line of credit because they didn't have that with their existing product. The clients were basically looking to bring their family in from overseas, purchase a larger home so that they can all stay together. Obviously, because rents were elevated and the clients, based on their income, their mortgage size was very affordable. Based on that information, the clients were comfortable with the variable rate product because they weren't sure exactly what they were going to do and when that timeline was going to happen. And they didn't want to be paying exorbitant penalties to get out of their mortgage. They were aware that, hey, this mortgage with the better rate was on a static payment, and they were fully comfortable with that, signed the disclosure documents, and off we went. Now, fast forward, obviously, the last few months, we've seen the Bank of Canada on a rate hiking cycle, and the clients reached out to us back in July asking us for our opinion on what would be best for them. Now, obviously, it's very difficult for us to give a client a decision, especially when it comes to choosing between a fixed and a variable rate product. If you're asking for an opinion versus what the client should do or what you should be doing, it's a completely different ballgame when it comes to budgeting and your finances on your home, and obviously what the journey is. So we spoke to the client, they had said, look, they're still looking, their parents are in the process of getting all their paperwork in order and trying to make the move over here. And the clients just wanted to know if being in a fixed rate product would be more beneficial because they are scared of where their trigger could be and obviously what their payments will end up becoming if the Bank of Canada continues to increase. And there is another rate increase on October 26th and then the final one for 2022 on December 7th. So when we dove into the client's finances, we looked and sort of said, okay, first and foremost, when the client called back in July, they were offered a fixed rate of 5.5%. When they called for the month of August, they were offered 5.34%. So obviously there was a little bit of a change there. It went down a little bit in their fixed rate requirements. And we'll get into some more of those details closer to the end of the video. But looking at the client's information, we said, okay, if you were to take on a fixed rate mortgage at 5.34%, at this current moment, your payments would jump to $3,879.11 as opposed to if you were to stay on the variable. Now, on the variable side here, we look and I have a rate of 4.2, but we priced in that extra 50 basis points to give them an idea of what their payments would basically look like at the current prime rate of 4.2% with a 50 basis point increase. Now, obviously, this is hypothetical. If you want to run your own personal scenarios, you can download our link in the description box below and play around with some of these numbers. But basically, the client's payment would have been $3,423.12, a difference of $455.99 per month. And the client, yet again, had basically said, you know what, Anth, based on that information, we're still going to hold steady on the variable. We've made it this far. I think we're better off. We have increased our payments to a little bit higher amount, and we're still comfortable, but still a $455 runway. Even if the Bank of Canada increases, their belief system was that things will change in the future, and they're entitled to have that. The idea was not to basically coach them into a scenario. It was sort of to say, look, these are the numbers. This is what you're going to have as a payment. You reached out to the bank. They told you what they're going to give you, and now you have a decision to make. But more importantly, the clients are looking at the current state of affairs in the housing market and saying, our income is still strong, and home prices are definitely falling. Yes, we won't be able to sell our home for as much as it would have been just a few months ago, but with our parents coming over and the cost of rent, their position with income, we might not be able to port that mortgage over because obviously rates are elevated right now and qualification might be a little bit more challenging. But obviously to avoid those penalties, because if they were to lock into a fixed rate mortgage today, and although they might have been comfortable paying $455 more per payment, the question was the penalty, because if rates do come back down and they're locked in for the remaining term of their mortgage, which would have been around just under 4 years, the clients would have been very concerned with that cost. And that cost would have superseded the actual amount that they would have been paying per month, especially because when you look at how interest rate differential is with your major banks, they're using that posted rate and they're calculating that penalty based on that amount. And if the rates are lower than the current rate, the penalty is going to be greater. And once again, just to reiterate, the clients were looking to make that move when the parents arrived. It could be a year from now, it could be 6 months from now, but basically the clients were positioned to make that move. So there's a lot of different factors and equations that you need to look at when you're making that decision, especially because you're going to be getting a phone call, maybe a letter in the mail from your lender if you are breaching that trigger rate. And a lot of clients out of fear may decide to lock into a fixed rate mortgage. And that is sort of the sentiment that we're hearing as some of our clients are calling us saying, hey, banks are calling us saying, lock into a fixed rate mortgage. And what do we do? And I said, as long as you're armed with the data, you have to make a decision. Are you 2 years out? Are you 3 years out? Are you 1 year out? Are you still at the beginning of your mortgage? And by doing that, are you comfortable with maybe having a higher rate when rates come back down, or if rates come back down? That is the major question when you're looking at fixed rate mortgages, right? Remember, I always say with fixed rate mortgages, you're paying a premium for that security blanket to know that your payments are going to remain the same for the duration of your mortgage. Some clients that take on the variable rate mortgage are comfortable with that volatility. Obviously, the last 5 months have proved to be a little bit more of a challenge. And we start to hear a lot of people saying, I wish I would have, and I wish I could have. Some clients, maybe they were always in a fixed rate and decided to go into a variable. Obviously, in hindsight, everything is 2020. And that applies to Canadians that are also looking at their current mortgage renewals, right? This is something that we were talking with the clients about too, because they were saying their friends had got their mortgage renewal and they were at a very low rate. And now their renewal rates for 5-year fixed are very expensive, even 3-year options. And their variables are still relatively, good at this current moment. But obviously understanding those scenarios and clients that might be in that particular position where they're coming up for renewal, whether it be through an A bank or even an equity bank. If you're with a B bank like those Home Trust and Equitables of the world, you're going to see those interest rates definitely be elevated right now. Some clients that we worked with just last year were getting rates that were sub 4 on the B side, on the B space, which means if clients don't fit the requirements for the A bank, and they're still looking to do something, or they were forced into making a purchase and, they didn't qualify for whatever reason it was, and you had to put them in with those lenders, those payments on those 1 to 2 year products are definitely going to be more expensive. But reach out to us here at In Touch Mortgage Solutions if you're on the B space, and definitely see if we can negotiate something for you, or reach out to your mortgage professional and have a discussion about those renewals. But more importantly, as we were talking about earlier on, is where the Bank of Canada is headed. And obviously September 7th is a pivotal move for some Canadians with trigger rate sensitive mortgages. And it's important to understand, the other 2 rate announcements where Canada sits with Governor Tiff Macklem. We heard from Jerome Powell just last week, which is the head of the U.S. Federal Reserve, and they've basically had some very good, strong sentiment that they're going to remain in tight monetary policy for a long period of time, which means we're not going to see any relief when it comes to interest rates. We are still in the rate hiking cycle, according to what they're saying based on economic data, but they are monitoring the data as it comes out. So that could change. But if we have to take what they're saying at face value, we are definitely in for some increases down the road, at least to cap off 2022, as we wait for the obviously August data to come out with inflationary numbers. We did see in July, obviously, a dip in the inflationary numbers here in Canada, but obviously core inflation still being relatively elevated in many different sectors. And the major proponent, the major thing that I'm looking at is right now it's a very early on. When we hear the Bank of Canada and the U.S. Federal Reserve having these discussions, they're generally in lockstep or in unison. So if one raises, then the other usually will follow suit. And although our economies are different, they are so correlated that, we have to take that into consideration, that we will potentially see some future increases. Now, when it comes to fixed rate mortgages, something we're talking about with our client, we were indicating to them that you saw that in July, obviously your fixed rate that you were quoted was much higher than it would have been in the current month of August. And that's because we're starting to see some change in the bond market in the 5-year treasuries as these 5-year fixed are changing. They're retreating from their highs. Now, obviously, it is something that is happening at the current moment. Where it's headed, obviously, because of recessionary fears being priced into the market, is very uncertain. We don't know if that's going to be a continuing trend. But basically, clients that are locking into a fixed rate mortgage from a variable have to be aware of that actual fact. If you're locking in today because you're scared and you're fearing what will happen in the future, and those are things that are keeping you up at night, obviously, you have to make a decision. We always tell our clients, you don't lose sleep over it. If you're comfortable with extra payments and paying a little bit of a premium, lock into a fixed rate mortgage if it better suits your family's needs and your anxiety levels, and you're going to sleep at night. But if you're okay with the volatility and you see the difference in the payments and you're able to compensate by adding money or prepaying some of that mortgage down, don't forget you can do that. And another key important factor is if you're in a variable rate mortgage and you do increase your payments by the maximum allowable amount, you can basically come back down to your original payments if you haven't hit your trigger rate. So if you're looking to do that as interest rates come back down, maybe in the near future, if you think that in 2023 or 2024, we're going to see the Bank of Canada pause on those rate increases or maybe pull back based on a recession, if that's what you believe to happen, obviously you need to take those things into account and understand where things are going. But obviously we don't have a crystal ball, and there's so many different sides of the equation. We see some articles coming out from CIBC strategists indicating that, the bank hiking policy is at its end. Some saying, hey, we're still in for some pain. Whether you stand on either side of the fence, it's always important to, plan for the worst and hope for the best. And when you're making those decisions, I always say, clients, let's take into consideration future increases. If it doesn't happen and you're prepared for it, it's better than not being prepared for it at all. So we'll leave the video here, and we hope that everyone has a great weekend. We wish everyone all the best, and thank you again for clicking, and we'll see you next week. Stay tuned.